So a little bit about me. I've been in asset management, REO asset management forever, since Lassie was a pup. I started at Fannie Mae, and I went to the FDIC, and I ran their asset management department during the crisis. We closed about 150 banks and disposed of about 23,000 assets. Currently, the company that I work for as Director of Business Development is called In Ocean Enterprises. We manage about 10,000 properties for HUD across the U.S. So we work in the foreclosure market space, and I'm sure as you guys can attest, there are a lot of opportunities there if you're not afraid to get your hands dirty. What I mean is that over the last, I would say, year, we've seen a lot of investors come into the market space. Blackstone, is it Blackstone? BlackRock? Something to do with rock. Blackstone, a lot of the big guys are coming in, and if you want a property that's broom swept and ready to be rented out, you can, there really aren't a lot of discounts available. They're about at market rate. Because we're a national asset management company, we're not afraid to get our hands dirty. We acquire properties that need rehab, and we can get them at a substantial discount. So we put a fund together to start acquiring some of these properties. We're acquiring about 228 properties across 5 different markets that we identified. 20% discount after repair value. We'll buy them even if they don't need rehab, but we at least need a minimum of 20% discount over current market value. We'll rent them up. We get a return to the investor. I shouldn't say conservative. A reasonable rate of return is 8%. Or 12% or 8% to you, paid out quarterly to you guys, and then it's a 5 to 7 year hold period, and then at the end of the 5 to 7 years, as we start to dispose of the assets, we'll split the dividends or the appreciation with you 50-50. What investors like is that we give out a preferred return of 8%, paid out quarterly, and then the discount on the ability to get a discount over current market on the properties. We currently have, so Joe put up earlier where you have 4 different types of quadrants of the types of people that are required to do a fund. We partnered with a company that currently does funds for a living. They have several different funds on properties. They have an REO fund, hard money fund, and commercial funds for different properties. We partnered with them, one, for their ability to help us raise the capital, but also because they have boots on the ground in the markets that we're doing that are actively identifying, acquiring, and rehabbing and leasing up these properties. So, enough from me. Any questions from you guys that I can cover? Yes or no, maybe?
These are properties you're buying in bulk on an REO basis after they foreclose. Is that right?
After they foreclose, yes. So, in bulk and not in bulk. We'll acquire them however we can to get the best discount, but bulk properties are highly competitive right now because the big guys are in. So we have a lot of boots on the ground that are identifying these properties. They're actually wholesalers that have these properties. So they have about 600 properties in their inventory currently, and they keep turning through them, our different wholesalers. So bulk isn't necessarily the acquisition strategy. It would be if we can get a decent discount and we have the capital. We would take it down bulk, but one at a time. So it's highly labor intensive. But we have
one of the things is you're not buying garbage houses. You're buying good houses,
right?
That are people lost them,
right?
Aren't in the market, but they're good renters and stuff like that. So you have a better story there than I think you portrayed for the room.
Right. Well, so I can tell you that. So working at the FDIC. When the FDIC went bust and we started taking down all these banks, in the late 80s, during the S&L crisis, the FDIC created the RTC to deal with this. It was about 5,000 people, and they even closed a bank. They closed, I think, 1 bank from the 80s to now, and so they let all of their experience go from the RTC. All these guys left, and so when we came back in, we as an asset management company working for the FDIC, we hired all these RTC guys back in. And so they would tell us all these stories about how this was the greatest transference of wealth from the government, and it was a huge land grab. But because of the recent foreclosure crisis, which I think is 2 or 3 times bigger than what the RTC was, so all of these properties, all these banks failed. The government came in and provided capital, and then through Fannie Mae and Freddie Mac and all of these GSEs that were assumed by the government. The government became a huge landowner again, and the government isn't in the business of holding property, so they're disseminating the property back to private investors, and we're going through the largest land grab or the largest dissemination of wealth from public to private investors, and that's exactly the niche that we're focusing on in this REO market. I don't know if that clear. We have a limited number of opportunities available for you guys. You know,